Hi there, I'm verified champion trader Kevin Davey, and today I'm going to give you some quick algo trading tips. I think you're going to love number 4. So let's get started. Before we get started, if you haven't signed up for my free algo strategy, now's the time to do so. Hit the QR code or enter the link you see at the bottom, or in the description, you'll find a link. Sign up, you'll get this free algo and lots of other great information. Some algo trading tips. The first one is related to back testing. And actually, all the tips are kind of related to back testing. They flow from one to the other. But let's just start with general back testing. A lot of people think, oh, you don't really need to back test, or back test doesn't tell you so much. Is that true? Well, I ran a month-long contest in September where I traded an AI bot that hadn't been back tested versus one of my bots that had been back tested. And when I went back and looked at it during the contest, I saw this is what the AI bot looked like backtest wise. I mean, it was just a pure money loser. I should have never traded it. And with slippage and commission, it just was terrible. Where my algo since 2010 did pretty good. Now, obviously, that's just one example of a bad backtest versus a good backtest, but my bot with the good backtest had better live performance, and that's what I did in the month-long contest. Now, obviously, that's one data point, but that does hold up. If you have a profitable backtest, they tend to be profitable going forward, or at least they have a better chance of being profitable going forward compared to one that just lost money. So I really shouldn't have expected too much from that AI bot. And if you go back and watch some of my other videos, you'll see it delivered as far as being bad. So since the AI bot did not backtest, I'm guessing I asked AI ChatGPT in this case to give me a good bot, and probably what it did was it just found something out there that didn't have slippage and commission added in, because without slippage and commission, that bot looked okay. But that's a real world cost. And that kind of leads into tip number 2. So tip number 1, always backtest. Tip number 2, you've got to make sure you have good matching in your backtest. And what do I mean by that? So when you run a backtest and then it runs live, your strategy backtest engine should give you the same results as your live performance, or at least pretty close. And one thing you can do is you can actually track those. Here's an example where the blue line is actual real money, and the orange line was what the backtest said with slippage and commission. In this case, through 10 trades at least, the blue line was better, meaning that whatever I estimated for slippage and commission with the orange, I was getting better performance with real money. So that's a good thing. You want that blue line, your real money, to be above the orange. Now, if I had not assumed any slippage and commission, then it would have been flipped. And that's why you always want to include slippage and commission estimates in your backtest, because it will make for more realistic results when you trade live. So talking about slippage and commission, here's tip number 3. Obviously, you have to properly account for this. And the interesting thing, if you test a lot of strategies, most of them make money if you take away the trading costs. And that's why you see a lot of research papers, especially like PhD research papers, where they say, well, these results, look at them, they're profitable, and then it's somewhere in the footnotes they'll say, we did not include slippage and commission. And sometimes they say, well, it's because every broker's different or some kind of nonsense. But really, the reason they didn't include it was probably because their results would turn negative when they did include it. So you always want to include that in what you're doing, okay? In the contest that I ran, I was trading ES, the mini S&P, and I used $25 round trip slippage or round turn slippage per contract and $5 commissions. Now, you could possibly get better. The slippage, probably I'm being a little conservative, and you could see that on that earlier chart I showed where the blue curve was better than the orange. I'm probably overestimating slippage a little bit, but every once in a while you get hit with this huge slippage that you didn't expect, so it kind of evens out. The 25 is pretty good. Every market's different. Some markets can be really bad. Gold, for example, I once literally had $2,900 slippage for one contract. It's crazy. It was a huge amount of slippage. And I normally don't expect that much, but that's what can happen sometimes. It was just a market order or a stop order, I forget which, and it was during low liquidity time, and bam, I got hit with a ton of slippage. You want to be conservative in your slippage estimates and make sure you vary it market to market. And again, there's an example of real world slippage versus what I would expect. And so the fact that I'm a little conservative, hey, that's fine by me, because then, it's better to be on the good side than on the bad side. The fourth tip I want to give you is related to the backtest historical length. So all of these involve back testing, but what's a good length? Should I test for 1 week, 1 month, 3 months, 2 years, 20 years? How long? Well, the idea with back testing is you want the market to do a whole bunch of different things and then have your strategy experience it. It's kind of like a stress test. Can it handle bear markets, flat markets, volatile markets, bull markets, all types of different market conditions? And if it can't, how comfortable are you going to be trading it going forward? Now, a lot of people use tick data to trade with. The problem is you usually only have 6 months of tick data with most trading data vendors. You can get longer data, makes it a lot tougher to test with. So I always use minute bars. I go down to 1 minute bars. Now, the big thing here is, does the backtest length matter? I mentioned tick data, you can do up to 6 months. Is that long enough? Should you be doing a longer test? Maybe it's a 10-year test that does better. I ran a study with a couple of strategies, so this isn't what I would call an exhaustive study, but basically along the x-axis I have the backtest length. So the longer length backtest is over to the right, shorter ones to the left. And then I plotted it versus the backtest predictability, or if the backtest was profitable, was real-time profitable, and that's what you want. So ideally, this would be 100%, meaning every time you ran a profitable backtest, you got a profitable real-time result. And I did 3 years of real-time. So the backtest might have been a month, then I ran it for 3 years and tried to see if those two would correlate. And what you can kind of see with this curve is the longer the backtest, the more possibility, or the greater possibility you have of the real-time performance being profitable. So real small, short tests, a couple days or that kind of thing, chances are it has no predictability for the future performance, where if you did a 10-year test, then you're a little more likely to be profitable during that 3 years. So that's kind of interesting because it shows that the longer back tests are better, and probably this curve kind of flattens out, I would imagine, if you ran longer ones. But this might be something you want to research on your own and see if you agree with my results. But my impression is, hey, probably a 10-year back test or longer is probably a better thing to do than a 1-month back test. And that is what that says right there. So let me know what you think. Did you like these tips? These tips are pretty important to algo trading. They're pretty simple, but I think they can be of really good use. I'm Kevin Davey. Have a great day.